there is this very specific, just very quiet kind of anxiety that happens at like 2 a.m.
Oh, yeah. The 2 a.m. reality.
Right, exactly. The forensic diagnosticians actually call it the 2 a.m. private reality. And I mean, I really want you, the listener, to put yourself in this headspace right now. Imagine you are a portfolio operator.
Yeah, you're running, maybe 5 to 30 plus locations?
Exactly. Maybe it's a regional food and beverage chain or, a sprawling retail footprint. Maybe it's a really complex franchise network. And your top line revenue is sitting comfortably in that like $2 million to $20 million plus range.
Which sounds great on paper.
Right. On paper, your public persona is just flawless. You are the visionary.
Yes.
It is all about growth. It's aggressive expansion, opening that next flagship location, scaling the empire.
But privately.
Yes, privately.
Yeah.
At 2 a.m., the house is completely silent, and you are just sitting alone at your kitchen table staring at your dashboard.
Yeah.
The revenue line is, it's ticking up. The locations are fully staffed.
Regional managers are sending in those positive daily recaps.
Yeah. Your team is putting in grueling hours. And yet, and this is the kicker, the actual cash in the bank account does not behave the way the revenue numbers say it should.
Not at all.
It just feels like money is being quietly, systematically extracted from your business without leaving a single trace.
And honestly, the most maddening part of that 2 a.m. reality is the conversation you have the very next morning.
Right, with your accountant.
Exactly.
Yeah.
You call your accountant or maybe your fractional CFO, and they look over the P&L, they run the standard historical numbers, and they tell you that everything is, quote unquote, within normal range.
Which is just so frustrating.
It really is. They're like, well, the margins look standard for the industry, labor costs haven't tripped any major alarms.
And you're just sitting there thinking, if everything is so normal, if my P&L is perfectly acceptable, why does my cash flow feel like it's on a ventilator?
Right. And you start thinking you're crazy. But this isn't some unique paranoia. It is a highly documented systemic phenomenon in multi-unit operations.
And we really need to emphasize this right out of the gate. This is not because you have like an incompetent executive team.
No, not at all.
And it's not because there's massive, Hollywood-style embezzlement happening in the back room.
As exciting as that might sound, no.
Right. And importantly, it is not because your accountant did anything wrong or made a math error.
Right. Standard financial statements are just simply not designed or engineered to show you true structural profitability in real time. They just aren't.
Which is exactly why we are plunging into this deep dive today. We are talking directly to you, the portfolio operator. We are going to unpack the exact reasons why your multi-location business might be growing its top-line revenue while simultaneously just draining its cash reserves.
And we have an incredibly fascinating stack of materials to go through for this.
We really do. Internal strategy documents, technical methodologies, academic case studies.
And actual forensic output samples.
Yes. Detailing something called the Forensic Intelligence Protocol, or FIP. This is a system built by Gusti DeVito, who operates not as a traditional management consultant, but as what he calls a profit diagnostician.
I love that term, profit diagnostician.
It's so good. And our mission today is to equip you with the mental models of a profit diagnostician. We want you to be able to spot what is known as structural margin decay.
Before it compounds.
Right, before it compounds silently over years and threatens to completely dismantle your entire network.
So to really grasp this, I think we have to pull back the curtain on the fundamental disconnect between traditional accounting and forensic business intelligence.
Yeah, let's unpack that.
We need to look at what a P&L actually is. Your standard accounting, the profit and loss statement, the balance sheets, cash flow statements, they act as a snapshot.
Just a moment in time.
Exactly. The entire architecture of standard accounting is inherently historical. It records what has already happened. Its primary function, historically and legally, is built for compliance.
Right, like paying taxes.
Yeah, satisfying the IRS, keeping board members happy, and just keeping a basic historical score of transactions that have already cleared the bank.
Okay, so a profit diagnostician, however, operates on a completely different timeline.
Right.
And with a radically different objective.
Totally. They aren't looking at the past to appease the tax authorities. They are hunting for what is happening right now, actively, in the operational blind spots.
In the structural gaps that you don't even know you should be measuring.
Exactly. They track the trend, the specific velocity of your cash, and the structural patterns across time, rather than just tallying up receipts at the end of the month and shrugging when the math balances.
Okay, let's unpack this with an analogy. Standard accounting is essentially like looking at the scoreboard after the football game is completely over.
Oh, that's a good way to put it.
Right. It tells you that you lost, and it tells you by how many points. It is purely descriptive.
Yeah, the game is already done.
It's exactly. But forensic profit diagnosis, that is like being the defensive coordinator on the sidelines, watching the plays develop in real time, and seeing exactly which linebacker is 2 steps out of position.
Right. Or which defensive line coverage is crumbling right before the points are actually scored against you.
Exactly. You're looking at the mechanics of the loss, not just the outcome of the loss.
That is a highly accurate way to frame it. And the reason standard accountants consistently miss that crumbling defensive line is because of how they are trained to view data.
How do you mean?
Well, they view variables in absolute isolation. They look at a spreadsheet and say, okay, your operational expenses are up 10% this quarter, and they just leave it at that as a descriptive fact.
Like, hey, it went up, moving on.
Right. Or they look at a 2-point drift in your food and beverage costs over 6 months, alongside maybe a 9% drop in your labor productivity over the year.
Which doesn't sound like a lot in isolation.
Exactly. Because those numbers are small, they're incremental, and they haven't tripped any catastrophic rule-breaking alarms. So the accountant labels them as explainable variations or just fine.
Right. Fine. The most dangerous word in business.
No, totally. But a diagnostician relies on a mechanism called cross-correlation logic.
Cross-correlation logic. Okay, I want to make sure we don't just gloss over that term, because that seems to be the engine driving this entire forensic approach.
It really is. They fundamentally refuse to look at any metric in isolation. They map cause and effect across totally different operational silos.
So cross-correlation logic is basically like diagnosing a car engine, right?
Yeah, that's a great comparison.
Like the standard accountant looks at the gas gauge, sees it going down faster than usual, and says, well, you're running low on gas. The solution is obviously to pull over and buy more gas.
Right, which sounds logical until you look deeper.
Exactly. The profit diagnostician looks at the gas gauge, but then cross-references it with the puddle of fluid under the chassis, the smell of fumes in the cabin, and the sudden drop in engine pressure.
Right.
And the diagnostician says, do not put more gas in this car. You have a severed fuel line. Pouring more fuel into the tank just means you're leaking faster.
Exactly. Let's look at how that actually plays out in a real operational scenario from the case files.
Yes, let's get into the files.
Okay, so suppose your cash runway is severely low, meaning the actual number of days your business can survive on its current liquid reserves, and simultaneously your gross profit leakage rate is high.
Okay, so you're low on cash and bleeding profit.
Right. Now, an isolated traditional view might look at that low cash and say, we have a liquidity issue, we need to drive more sales, launch a massive marketing promotion, and just get more cash in the door.
Pour more gas in the car.
Exactly. But the cross-correlation logic engine issues a completely different verdict. It flags a dangerous correlation. It connects the low cash directly to the high profit leakage and realizes the core mechanism of the business is broken.
Wow.
The diagnosis isn't that you lack revenue. The diagnosis is that you are bleeding internally. You are consuming capital at an unsustainable velocity.
Right, so pumping more sales through the system without fixing the leak won't save you.
It will actually accelerate your demise. You are scaling an inefficient, leaking structure. Every new customer you acquire is actually costing you money because the cost to serve them is deeply broken.
That is wild.
Yeah.
And so if standard accounting labels all these tiny inefficiencies as fine, what happens when you stack a dozen fine inefficiencies on top of each other over 3 years?
That is the big question.
That leads us directly to the underlying villain of our deep dive today. This explains why the dashboard looks green while the bank account is flashing red. It is because of something called structural margin decay.
The silent killer.
It really is the silent killer for multi-location operators. The sources define it as the slow, invisible drift of cost ratios that never violates a single accounting rule and therefore never triggers a formal alert.
It's just a tiny percentage here on packaging, a tiny percentage there on overtime.
Right. Let's walk through the math on this, because when you aggregate structural margin decay, the impact is just staggering. And it happens right under the nose of incredibly smart operators.
Let's do the math.
Okay, Imagine you're running a $5 million retail or hospitality operation.
Okay, 5 million.
Over the course of 12 to 18 months, your cost of goods sold drifts upward by just 2 points. Let's say vendor prices creep up or there's slightly more waste on the floor.
2 points, nothing crazy.
Right. Meanwhile, your labor productivity, the actual revenue generated per labor hour, drops by 9%.
Maybe managers are overscheduling slightly to make their lives a little easier.
Exactly. And finally, let's say your cash conversion cycle. The time it takes for inventory on your shelf to actually become usable cash in your bank account that stretches out by 25 days due to logistical friction.
Okay, so you've got these 3 totally separate metrics drifting.
Right. But because every single one of those metrics is still technically, quote unquote, within normal range for your specific industry, the P&L just absorbs it.
It doesn't flag it as a crisis at all. It's just business as usual.
But when a diagnostician combines those isolated drifts, that is $300,000 to $500,000, completely evaporating through the gaps in your operation.
Yeah, $500,000 just gone.
$500,000. And there is absolutely no red siren going off in the finance department.
Nope, none.
I mean, a 2-point drift on a $5 million P&L is barely a blip on a monthly spreadsheet. Are you telling me that a variance that small is the difference between comfortably scaling the business and slowly suffocating?
It absolutely is, because it scales brutally with your revenue.
Right.
If we extrapolate that same scenario to a $10 million multi-location operation, a combined 4-point drift across your materials and your labor equates to $600,000 vanished.
Wow.
Completely wiped out of your net profit. And the truly terrifying part of structural margin decay isn't just the sheer volume of cash you are losing.
What is it?
It's the timeline. Because this decay is so incredibly subtle, and because it fully complies with standard accounting principles.
The Jack rules.
Right, GAAP. Because it complies on the time it surfaces in a way that you absolutely cannot ignore, like, missing a payroll cycle or defaulting on a vendor payment, you have already lost 2 to 3 years of compounding profit.
That is terrifying.
The business has been bleeding out silently for 36 months before you even realize you need a tourniquet.
And if you're a multi-location operator, which is exactly the listener we are talking to, this margin decay is magnified exponentially by a concept called the replication risk.
Oh, the replication risk is fascinating.
I found this so interesting in the sources. So if you have one branch out of 50 that discovers a tiny operational loophole,
like an unauthorized way to override the point of sale system to grant a discount?
Exactly. Or maybe a shortcut in inventory management that creates a higher rate of spoilage. That loophole does not stay isolated to branch number 4.
Definitely not.
It usually spreads to 10 other branches within weeks.
Because the staff talk.
Right. Regional managers talk. They have WhatsApp groups. Someone says, hey, you enter this code. You don't have to count the inventory manually.
And suddenly it's everywhere.
Exactly. Yeah. Without a deterministic system for pattern detection constantly scanning across your entire network, you are suddenly bleeding cash everywhere, and you are entirely blind to the source of the hemorrhage.
And this specific dynamic is exactly where the traditional consulting model completely fails the portfolio operator.
Oh, totally. A traditional business consultant will look at this stagnating cash scenario and tell you to add more water to the bucket.
Right, meaning they will advise you to run a new, aggressive marketing campaign, rebrand the storefronts.
Open 3 more locations.
Yeah, and drive top-line revenue to outpace the operational losses. They focus entirely on top-line growth.
But a profit diagnostician operates strictly on the bucket hole philosophy. Their mandate is not to add water. Their mandate is to plug the bucket.
Exactly. They are entirely focused on recovering the capital that you have already earned, the revenue that customers have already handed you, but that is exiting the organization through operational friction before it ever hits your bank account.
Okay, now I have to ask the question that I know every 20-location operator is screaming at their speakers right now.
What's that?
The bucket hole philosophy sounds amazing in a theoretical boardroom, but let's be real. I have 50 locations. I have 800 minimum wage employees.
Right.
I have managers who turn over every 8 months. I cannot physically clone myself to be in 50 kitchens or 50 retail stockrooms at once to watch them overportion the French fries or mismanage the Tuesday morning shift schedule.
You literally can't.
Right. How is a CEO actually supposed to spot this if the official corporate P&L is hiding it? Honestly, in 2026, can't I just take all my spreadsheets, upload them to ChatGPT, and ask the AI to find my inefficiencies?
It is a very valid challenge, and it is a trap a lot of modern operators are falling into right now.
So why doesn't that work?
Well, the fundamental limitation of standard large language models and AI prompts in this specific context is that AI only works with the data and the conceptual framing you provide to it.
Okay.
If you feed an AI your standard accounting spreadsheets, it will give you standard accounting frameworks right back.
Oh, I see.
It will tell you which industry standard ratios to watch, or it will generate a list of general high-level questions to ask your CFO. But here's the critical flaw. You can only prompt an AI with what you already know to measure.
Wow, okay.
Structural margin decay hides exactly in the gaps between what you know to measure and what is actually moving in the real physical world of your business.
Right, because the AI doesn't know what's happening on the physical floor of branch number 7.
Exactly. A standard prompt cannot cross-correlate your localized labor density against your cash conversion cycle against your contribution margin per location, and then instantly tell you which specific operational combination is extracting $18,000 from your network every single month.
Right.
That requires a deterministic forensic engine built to structurally expose the exact path of capital. AI is an incredible synthesizer, but it is not a forensic auditor of physical operational realities unless it is fed deterministic, cross-correlated data streams.
Okay, so let's talk about how the diagnostician actually gets those deterministic data streams, because here's where it gets really interesting.
Yeah, the case files.
Yes, the case files we have give us actual verified examples of what this looks like in practice when a diagnostician applies this system. Let's dissect case file FIP 9920Z.
Ah, the phantom payroll case.
Yes, the phantom payroll. This is a retail fashion brand with 9 outlets. On their standard monthly reports, everything looks absolutely fine.
Totally normal.
Labor percentage of revenue is within the industry benchmark. But the forensic audit didn't just look at the payroll expense line. It cross-referenced their employee attendance logs against their point-of-sale throughput.
Right.
Meaning they mapped exactly how many physical bodies were clocked in and working on the floor versus how many transactions were actually happening minute by minute, hour by hour.
And what's fascinating here is what that specific logic trace revealed. It found a 22% idle labor rate.
22%.
Yeah. The business was paying full salaries for roles that essentially only existed on paper during those hours. And here's how that actually happens on the ground psychologically.
Yeah, how does that happen?
Well, store managers hate being understaffed during a sudden rush.
Oh, of course.
It's stressful, customers get angry, and the manager takes the brunt of it. So to protect themselves, store managers will universally buffer their schedules.
Right.
If they think a Tuesday afternoon might get busy, they schedule 3 people instead of 2.
Just in case.
Exactly. So every single shift designated as peak hours had excess staff just standing around folding the same sweaters over and over, all on full pay. The transaction volume simply did not support their physical presence.
Wow.
By structurally exposing that gap, showing the owner that the legacy scheduling software was failing to match actual historical foot traffic with labor deployment, they realigned the labor to the actual throughput.
And what was the result?
They eliminated $61,000 a year in purely wasted labor costs.
Let's just pause on that for a second. That is $61,000 of pure net margin dropping straight to the bottom line.
Yep.
They didn't have to sell a single extra t-shirt.
Not one.
They didn't have to launch a new social media ad campaign. They just stopped bleeding the cash they already had.
Precisely. And let's contrast that with another incredible example. Case file FIP 7714A.
Oh, the invisible price war. This one was wild.
Yeah, it was an automotive service chain, a multi-bay mechanic operation, and the owner was incredibly frustrated, living that 2 a.m. reality, because he firmly believed they were suffering from thin margins due to a highly competitive, cutthroat local market. He thought his macroeconomic pricing strategy was the issue.
He just thought the shop down the street was undercutting him.
Exactly. But the forensic audit went much deeper than the aggregate revenue on the P&L. It looked at the transactional invoice level and found that the field technicians, the service advisors working the front desk, were unilaterally granting unauthorized loyalty discounts.
Right. And this is entirely a cultural issue disguised as a math problem.
Exactly.
The technicians were essentially giving away the company's margin to keep customers happy and to avoid conflict at the register.
Which happens all the time.
All the time.
Yeah.
The service advisor wants a high customer satisfaction score, or they just want the customer to approve the big break job, so they knock 10% off the labor without even asking permission.
Right. And the forensic data showed Those unauthorized discounts were averaging 8.7% per invoice.
Almost 9% of the gross. Just go.
And the owner was entirely blind to this because the total top-line revenue numbers looked okay, which completely masked the deeply discounted unit economics underneath.
The sheer volume of cars coming through the bays hid the fact that they were making significantly less money on every single car.
Exactly. By plugging this specific leak, which practically meant instituting strict compliance and lockouts on the point of sale system, so technicians could no longer physically alter the pricing matrix without a manager override.
Right.
The net margins of the entire business were restored from a frail 4.1% up to a robust 11.8%.
Wait, really? From 4% to almost 12%?
Yeah. That is a massive 187% increase in net profitability, again, achieved entirely through the recovery of stranded capital via operational discipline.
Not by acquiring new customers or outspending the competition on billboards. That is just staggering.
It really is.
And the mechanism they use to find these leaks, like the phantom payroll or the invisible price war, relies on something called logic trace analysis, alongside a 25-pillar map. Let's break those down because they're the core tools of the profit diagnostician.
Right.
So logic trace analysis, as I understand it from the sources, is a structural process that literally tracks the exact physical path of capital as it moves through a business.
Yes, it's looking for where the fundamental logic of a business transaction breaks down.
Right.
A business transaction is supposed to follow a logical path. For instance, if an expense is recorded on the P&L for purchasing raw materials, logic dictates there must be a corresponding output in the physical inventory count or in the final sales data.
Makes sense.
If you bought 1,000 pounds of flour, logic says you either have 1,000 pounds of flour sitting in the back room or you sold an equivalent amount of bread.
Right.
If the flour is gone but the sales don't match, the logic trace is broken. The capital has vanished.
Or, I suppose, if revenue is officially recognized in the POS system on a Friday, but it doesn't clear the merchant processor and deposit into the actual bank account within the expected time frame.
Yes, the cash realization lag. If that doesn't match up, the logic is broken. The diagnostician maps every single one of these paths to find the exact point of fracture.
And the 25-pillar map is how they systematically organize that scan across the entire organization.
Exactly.
It is essentially a full-body MRI for a corporation. These pillars represent a complete taxonomy of business risk. For smaller, single-unit operations, they might use an 8-pillar diagnostic. But for the 2 million to 20 million multi-unit portfolios we are discussing, they deploy the full 25 pillars to map every single vulnerability point.
It leaves no stone unturned. We're talking about mapping procurement processes, labor density, inventory decay, supply chain logistics, and financial reporting integrity.
So let's apply that MRI concept to a specific finding from the forensic sample report. This one involves a food and beverage multi-unit operation. The system identified a cross-pillar syndrome that it clinically named the cost of chaos.
The cost of chaos.
Which is essentially severe process waste. The system detected a massive gross profit leakage rate of 6.6%. Now, using the logic trace analysis we just talked about, it determined that 3.6% of that total leakage was driven purely by operational waste on the floor.
Wow.
Yeah, the clinical narrative in the diagnostic report literally states, your production line is burning money due to unmet recipe standards or disorganized execution.
It directly links the physical operational friction, the chaos of a messy, poorly organized commercial kitchen, the failure of line cooks to use accurate measuring tools, the disorganized walk-in freezers leading to spoilage.
Right.
It links all of that to actual dollar losses impacting the gross profit leakage rate. It takes the highly subjective, intangible concept of a sloppy kitchen and quantifies it as a structural financial hemorrhage.
That is such a crucial distinction. It's not just a traditional restaurant consultant walking in and saying, hey guys, your kitchen looks a bit messy during the dinner rush. You should probably tidy up. It's bad for morale.
No, not at all.
It is a deterministic algorithm saying, your failure to adhere to the standard operating procedure for portioning protein is mathematically responsible for 3.6% of your disappearing capital, which equates to $112,000 a year. And here is exactly which location and which shift it is happening on.
Precisely. And this brings us directly to the unique existential danger faced by portfolio operators managing multiple locations. The network blind spot.
The network blind spot. This is where it gets really dangerous for our listeners.
It does. When you are managing 20, 50, or even 100 plus locations, the aggregate data, the combined total of all your operations, becomes a remarkably effective hiding place for localized failure.
Wow.
When you look at total network revenue, the averages will actively lie to you.
The averages lie. That is a terrifying thought for an operator who lives and dies by their monthly consolidated P&L.
But it happens every single day. You might have total corporate revenue growth of 15% year over year.
Which everyone celebrates.
Right. You and your executive team are popping champagne, celebrating that aggregate growth, completely unaware of the underlying mechanics. You don't realize that your top 8 performing branches in high-density urban areas are generating an unbelievable amount of cash, while 12 of your suburban branches are quietly bleeding cash due to severe structural margin decay.
Oh, I see.
Those 12 failing branches are actively consuming the profits of the winners. Your crown jewels are secretly subsidizing your failures, and the aggregate revenue number completely masks the disease.
The FIP methodology is so incredibly blunt about this reality. There's a line in the source material that says, "Stop celebrating aggregate growth when 12 branches are quietly bleeding cash behind total revenue."
It's a harsh truth.
To combat this specific network blind spot, the system deploys 7 enterprise metrics, which they categorize as network intelligence. And these metrics are fascinating because they completely reframe how an operator should look at their portfolio.
Yeah, let's go through some of those.
We've got true unit economics, the royalty burden ratio, territory productivity, the network compliance score, the labor arbitrage index, supply chain friction, and capacity utilization.
We really need to break a few of those down because understanding them is vital for portfolio survival.
Definitely.
Let's start with true unit economics. This metric isolates the pure, unadulterated profitability of a single branch after deducting the central corporate royalty burden.
Right.
It strips away all the corporate subsidies, the shared marketing expenses, the centralized HR support. It forces the question, if we cut this single branch off from the corporate mothership tomorrow, could it actually survive on its own operational merit?
And what's the usual answer?
Often the answer is a shocking no.
That is a brutal stress test. And it ties right into the royalty burden ratio, which measures how heavily the central corporate overhead costs are crushing the survival chances of the individual branches.
Exactly.
If corporate HQ is bloated, you are forcing your local branches to generate impossible margins just to pay for the executive retreat.
Spot on.
What about the labor arbitrage index and supply chain friction?
Okay, so labor arbitrage index is brilliant for widespread geographic portfolios. It compares the efficiency of your workforce across different regions. It tells you if one territory is vastly outperforming another in actual operational output per labor dollar spent.
Oh, wow.
So if your locations in Texas generate 30% more throughput per employee than your locations in Illinois, you don't just accept that as a mystery. You have a quantifiable metric to investigate regional training or localized management culture.
That makes total sense. And what about supply chain friction?
Supply chain friction is something every operator feels but rarely measures.
What does that look like on the ground?
It looks like your main food distributor truck arriving at 12:15 p.m. right in the middle of your absolute peak lunch rush.
Oh, that's the worst.
Your kitchen staff has to abandon the production line to go out back and unload boxes of lettuce. Drive-through times skyrocket, customers drive away, and you lose sales. That is supply chain friction, physically destroying your daily margin.
And without tracking these specific metrics, operators fall straight into what the diagnostic calls the expansion gamble.
Yes, the expansion gamble.
Here is the trap most operators fall into.
Yeah.
If you don't isolate the true unit economics of your absolute best branches, if you don't know why your flagship store is profitable when you sign a lease to open a new branch, you aren't actually scaling your success.
Right.
You're just blindly scaling your hidden inefficiencies. You're copying the broken parts right alongside the good parts.
Exactly. You might be falsely promoting regional managers because their specific branches show high foot traffic and high top-line revenue, while in reality, due to massive margin decay, you are actually losing money on every single transaction they process.
And this specific dynamic leads to the most chilling clinical verdict in the entire forensic sample document we analyzed.
Yeah, this part is intense.
The FIP system flags a critical syndrome for the operator, and it names it the growth trap. I want to read the diagnostic narrative exactly as it is presented to the CEO.
Go for it.
It reads, Forensic analysis detects a dangerous paradox. Your revenue has hit 187.5 thousand for this period, but cash reserves are depleting rapidly, and your gross profit leakage is at 6.6%. You are scaling a structurally leaking business. The more you sell, the faster you move toward insolvency because your operational efficiency is not keeping pace with your scale.
Let's just sit with that for a second. The more you sell, the faster you move toward insolvency.
So what does this all mean for the operator sitting at that kitchen table at 2 a.m.?
It means the system intervenes aggressively. It literally issues a priority action order to halt expansion. It explicitly, mathematically warns the operator, do not push for more sales, do not open the new location, halt all expansion until contribution margins are healthy and the leakage is contained. Scale without efficiency is financial suicide.
Financial suicide.
Yeah.
I mean, if you are a portfolio operator and your entire personal identity, your ego, and your board's expectations are wrapped up in opening new locations, cutting ribbons, and driving top-line growth, this is a massive paradigm shift.
It's a total reversal of how they're used to thinking.
Aggressive expansion is not inherently a sign of health. If your bucket is full of holes, scaling up just means you are pouring water in faster, which means you are leaking water faster.
You are literally accelerating the rate at which you bleed out.
You are subsidizing your own demise with every new grand opening.
And that is the profound psychological shift this forensic methodology demands of leaders. It forces the operator to stop looking at top-line revenue as the ultimate unquestionable metric of success. It demands a hard pivot toward a concept called sovereign profitability.
Sovereign profitability. I like that.
Yeah, it's a state where the business is mathematically resilient at its core, where margins are fiercely defended at the unit level, and where earned capital does not leak through operational friction. But achieving that state requires bridging what the diagnostic framework calls the recovery gap.
Right, because getting a terrifying, hyper-accurate diagnosis that you have exactly 8.2 days of cash runway left is utterly useless if you don't know what to do about it. It just causes panic.
Exactly.
The recovery gap is the operational space between knowing you are bleeding out and knowing exactly which plug to pull first to stop the bleeding. A standard accounting audit just hands you a spreadsheet of your historical failures and says, good luck.
Just see you next quarter.
Right. But the FIPS system generates an automated action plan, which scales into a comprehensive 15 to 20 page recovery blueprint. It tells you exactly how to save the patient.
This is where the decision intelligence engine of the system proves its real-world value. It doesn't just list 50 things you are doing wrong.
Right.
It prioritizes actions based on a composite impact score, meaning it tells you exactly what single operational move will give you the highest return on investment per unit of intervention.
Give me an example.
So, for example, if the system's cross-correlation logic detects a high inventory decay metric, let's say you have dead stock, outdated retail items, or perishable goods that are literally rotting in a warehouse, tying up your precious working capital.
Okay.
It doesn't just present a graph saying inventory is high. It immediately prescribes a clinical step-by-step intervention. Liquidate dead stock immediately below cost to recover baseline liquidity. Implement just-in-time ordering protocols for these 3 specific vendors within 72 hours.
Wow, that's specific.
It provides the precise, sequenced operational steps required to unlock that trapped capital and get it flowing immediately back into your cash runway.
To translate that jargon for anyone who hasn't been deep in logistics recently, just-in-time ordering means you stop buying a 6-month supply of packaging just to get a tiny volume discount, because that cash is better used keeping the business alive today.
Exactly.
Let's look at the FIP sample dossier again to see this in action. The business's cash runway is at a terrifying 8.2 days.
8 days.
Right. The system scores that a 0.5 out of 10. It is a critical, flashing red flag. The narrative tells the operator point blank, imagine being underwater. That's how much time you have before you drown. Stop everything else. Find cash, NW.
Wow.
And then it gives the recommended intervention. Execute an emergency operational expense audit, eliminate all non-essential expenses within 48 hours, and accelerate receivables collection by offering early payment incentives to your clients. It's not a polite suggestion. It's an emergency medical protocol for a dying business.
And the implications of this go far beyond just surviving the month. If we connect this to the macro view of business ownership, the impact of executing this recovery blueprint fundamentally alters the actual valuation of the entire enterprise.
Oh, the valuation. This is huge for anyone looking to sell.
Massive. In the forensic sample provided, there is a fascinating section detailing capital impact and valuation. The business's current implied enterprise value, what a buyer would pay for it today based on its leaking, inefficient state, is calculated at roughly $1.01 million.
Okay.
That valuation is heavily discounted because any smart buyer will see the structural risks and the erratic cash flow. But the diagnostic engine calculates something called a strategic recovery upside.
What does that mean?
It mathematically proves that if the structural repairs are made, if the 6.6% leakage is stopped, and the operational chaos is organized into standard procedures, there is an addressable upside of $1.60 million in value.
Wait. I want to make sure I understand this. So just by fixing the internal leaks, just by cleaning the pipes and optimizing the labor scheduling, the enterprise value of the business more than doubles, from $1 million to $2.6 million.
Yes. Because you aren't just adding a little bit of cash to the balance sheet, you are dramatically improving the exit valuation multiplier.
Wow.
A business with a structurally sound margin, high data integrity, and zero operational leakage commands a massive premium in the open market.
Right.
Buyers don't just pay for your current cash flow, they pay a multiple of your profit based on how safe and predictable that profit is.
That makes total sense.
If your operations are a chaotic mess, they might offer you 3 times your profit. If your operations are bulletproof, they might offer you 7 or 8 times your profit. For a portfolio owner looking to eventually exit, sell to private equity, or bring in institutional investors, having a forensic audit from a deterministic engine like this acts as an instant gold standard due diligence tool.
The system actually issues a data integrity score.
Right. It does. In our sample case, the business actually scored a perfect 100% on data integrity.
Oh, that's interesting. So what does that mean?
This means that while the operations were messy, the numbers themselves were honest. They hadn't been cooked or manipulated, and an investor can absolutely trust the baseline data.
Got it.
But if that score was low, it would instantly alert an investor or the CEO that the financial reporting is deeply flawed, or worse, intentionally deceptive. It completely removes the smoke and mirrors from the valuation process.
This has been an incredibly dense, eye-opening journey into the hidden mechanics of multi-unit profitability. Let's do a comprehensive recap for the operators listening right now, perhaps still sitting at that kitchen table at 2 a.m.
Yeah, let's tie it all together.
We started by realizing that standard accounting is basically a rear-view mirror. It's absolutely necessary for taxes and compliance, but it completely hides structural margin decay, that slow, invisible 2-point drift that evaporates $500,000 a year while telling you everything is fine.
Yeah.
We learned that profit diagnosticians don't just look at isolated numbers. They use cross-variable car engine-style logic to track exactly where capital physically exits the business before it hits the bank account.
And we saw how that logic trace analysis exposes hidden operational realities like phantom payrolls driven by stress managers overscheduling, and invisible price wars driven by service advisors giving away your margin just to maintain customer satisfaction.
Crucially, for you, the portfolio operator, we uncovered the terrifying reality of the network blind spot. We learned that scaling an inefficient operation without having strict unit-level visibility means your few profitable branches are secretly funding your dozens of failing ones.
It's just a cycle of financial suicide, perfectly disguised as aggressive corporate growth.
Exactly. So what's the big takeaway here?
The overarching lesson is a profound, necessary shift in operational philosophy. The capital you are desperately looking for right now, the money you need to fund your next phase of growth, or to finally take the owner's draw you actually deserve after years of stress, is very likely already inside your business.
You don't necessarily need more sales.
No, you do not necessarily need to run a massive new marketing campaign or take on risky debt or open 3 new territories to find it. You need to locate the 15 to 20% of your margin that is currently vanishing into the operational gaps. You must definitively patch the holes in your bucket before you pour any more water into it.
Exactly. Stop subsidizing your own inefficiencies. You have to start looking at your operations not just as a revenue engine, but as a forensic landscape. Every single daily process, every Tuesday morning shift schedule, every inventory delivery that arrives during a lunch rush is a specific place where capital is either secured or lost.
This raises a critical final question, and it's an exercise I really want to leave you to mull over.
What is it?
We saw in the source documents that the FIP system runs financial stress simulations. It intentionally tests the business against wildly optimistic growth scenarios and devastating black swan shock events.
Okay.
I want you to apply that exact forensic mindset tomorrow morning. Look at your highest revenue branch, the one location you consider your absolute crown jewel, the one you show off to investors.
Right, the flagship.
Now, mentally strip away the sheer volume of its sales. If you isolated its true unit economics, strictly accounting for its specific localized process waste, its unrecorded point-of-sale discounts, its idle labor during off-peak hours, and its massive share of your corporate overhead,
Oh, okay.
would it still be your most profitable asset, or is it actually the biggest hole in your bucket, perfectly disguised by the massive, blinding volume of water pouring through it?
What a brilliant and slightly terrifying thought to end on. That 2 a.m. private reality might not just be stress. It might be your intuition accurately telling you the bucket is leaking. It's time to stop looking at the scoreboard after the game is over and start diagnosing the structure of the play. We'll catch you on the next deep dive.